you've got that competition resuming for, say, soybean exports. Welcome to the Comstock channel. I'm Joe Camp. I'm here to give a follow-up video from 2 weeks ago, the bullish and bearish grain market views. It was bearish 2 weeks ago. The video promised last week was a bullish follow-up. That video preempted by the birth of my second child, our daughter Valerie. I appreciate you now returning with me for this bull case I'm going to make. I gave the disclaimer last video 2 weeks ago that these were not necessarily my true opinions, that mine, as likely yours, fall somewhere in the middle, pulling both from the bullish end of different items and the bearish end, but also in between, somewhat more or less than the extreme ends. I want to give the bullish case and be bullish. If I were all cylinders bull now, I would just bring up as recently as yesterday this latest USDA crop report and talk about, well, are the USDA analysts now running out of ammo on bearish crop reports? That can be the case. The last two reports before that really ending up going along with this stocks update and just padding against large yield reductions that are still to come is going to be the base case here. But acres and now old crop stocks, those aren't the same threats in future crop reports. Of course, for the yield to change now depends on when we're going to get our next crop report, according to what happens with the government shutdown. And we're going to talk a lot about the government and politics, unfortunately, whether we like it or not. You know, it sounds like these farmer aid programs, for one, are something we've got to think about politically, to see those coming out and likely to remain open and flowing amid a government shutdown. This is going to be the bear case that this tariff money mentioned by President Trump in part could be in lieu of farmers accepting lower soybean prices and a further lockout of China in particular, while we know the bearish point is record business already accomplished between China and Brazil, and then lately Argentina. We have China's needs covered through at least November, and Brazilian next crop soybeans already to fill the pipeline by January. That's the bearish view. What we can say is that that's largely already priced into the market as a bear here, that we instead have it already well known, the seasonal aspect of leading into the new calendar year and skipping out on the busiest stretch of the season now for the U.S. soybean export program historically. So if I'm bullish, I'm thinking it's the alternatives to what the market's already priced in, and that those include not only a routine possible South American weather problem, but also what could be this rerouting of commodity trade flows by the terms of coming trade deals. You have to think that these now specifically address agriculture, with all the movement, with the text message picture from U.S. Treasury Secretary Scott Bessent received purportedly from USDA Secretary Brooke Rollins about the Argentine bailout and the funds provided to Argentina at the same time Argentina was dropping their export taxes and selling it all to China. There should be more follow-up, and if it's been bearish, the next possibility is also bullish, that you can have an outcome that does revisit specifically soybeans to China, but more generally now a renewed focus from the government on agriculture in these trade deals, not just with China, but other countries as well. And again, I'm doing this bull versus bear presentation, and I'm taking the bull side this time, but I want to say that I do believe it's not black and white on political preference, and that you have to lean one way to be bullish or the other says that you should be bearish. At the same time, of course, there's absolutely a huge political component in these markets, and you have to incorporate that into your outlook. Hopefully, though, with objectivity about what you think will happen, as opposed to necessarily what you think should happen or what you might want to happen politically. And so the bull here says that there's going to be political deals. They're going to be done soon, and they're going to be inclusive of help for agricultural prices, not just aid payments, but the direct focus on the prices themselves. You have possible restored confidence now and demand coming this fall, right at the same time the bull is going to say here that we're going to gain further confirmation, further realization of this disappointment in corn and soybean yields. We've got, it's staying political again, wondering if we're going to miss the October crop report or however many more of those updates because the government is shut down. But I think that as a bull, you should feel okay. Evidence from the farmer and from the market responses by commercial entities as well. These are going to be enough to corroborate the missed yield potential compared to our hopes and relative to loftier USDA estimates just a couple of months ago. The bear market outlook video that I did, I was arguing about the grains that, they don't have a chance at going higher this winter if financial markets are going to flip into risk off mode because of threats from recession and stagflation. All of that can keep investment capital at the sidelines, away from commodities. You have this overall worry. Why would you buy anything in the environment that we could be headed into? But I always talk about considering, again, alternative futures for how different issues can unfold. And one alternative to this worry about recession is that you don't count out the U.S. economy. No matter what your politics are, it might not be right to bet against the stock market, for example, which just reached new highs again last week. Or as they say, don't fight against the Fed. And the bearish case was that the Fed funds rate might go lower, but the rest of the Treasury market doesn't have to. What with all the bond vigilantes and the high government deficit and the persistent inflation. But the flip side of this is, one, again, that it's already priced into the market, and that the other path is also that interest rates actually do continue to ease here. And inflation might remain elevated. It's stuck these last couple of reports at 2.9% when you think the Fed might have a 2% target. But it can remain out there and without advancing any further be acceptable, especially if this inflation shifts to more driven by wage growth and a healthy labor market, and not just by goods that are having their prices rise at the same time that consumer incomes are on a downtrend. And all of that comes into play when you talk about federal employees, the government shutdown, still, an outlook for weakening in the labor economy that has triggered this initial rate reduction and likely more to come. But you can see this more bullish look if we do indeed have these interest rates moving lower heading into the winter. You've got this friendlier outside market environment that comes from, for one, the lower interest rates continuing the path lower for the dollar, improving those terms of trade for commodities, while at the same time you have more of a go-ahead and all clear for investment capital to rotate into the space here. That would dovetail as well with the grains getting that help from lower corn and soybean yields and then policy support for trade demand. A few other bullish grain market possibilities. You could have upside in prices for crude oil and energy markets, biofuel usage, and the optimism there being a bullish driver continuing into the new year. We've got the ongoing war in Ukraine, the conflict in the Middle East. This could all be a flashpoint for crude oil to go higher, despite what has been the bearish shift by OPEC and the insistence in part from President Trump to keep oil prices lower. If it slips out of their hands, like it can often do, and we get higher crude oil prices, that continued ramp up in biofuel capacity and that sector supporting demand. At the same time, again, you've got that competition resuming for, say, soybean exports. Then it's a different story fundamentally, and one that only reinforces that attraction of the capital into the broader commodity space. So energy markets, crude oil, one possibility. One other thing I think, if you talk about trade policy, about biofuel policy, I could be bullish too on the other big component, feed usage. That was a bearish link to this week's crop report, that you had those extra old crop stocks found left over, and this thought that, all right, we're missing a lot of cattle here, not only in the U.S. herd, but the supplemental flow of feeder cattle from Mexico. Okay, again, priced in. What will get any worse? Instead, the prospects for the Mexican border to be reopened, maybe at some point in the winter, we get a better handle on screwworm. There's been that political pressure from both sides to get the border reopened at some point. You also have this sign of traction being gained for the herd rebuilding effort just in general in the U.S. Some comments too about government intervention in that. But you have, not to mention optimism, the U.S. hog herd, disease mitigation going forward, not the same problem as it was once again this last winter. We can be optimistic about those things. We can be bullish about feed demand going forward. Again, relative to what we've just priced in as the more negative recent history. To flip this trend, to be bullish to grains right now, for me, it means primarily that I'm looking for the market to rebound in the face of all of these negatives. And again, that's something that happened with the most recent crop reports and still could, depending on the rest of the week's action following the September 30 reports. This idea that back in August, on the big shocker of a yield back in September with the big surprise on acreage, you've got now the wall of worry built up by those things. And now instead, the market swinging its short-term focus like a pendulum back towards the more bullish headlines related to yield reductions in future reports, possibly, plus, again, the anecdotal evidence from the farmers in the markets, and then the policy developments that can keep you buying into the end of the calendar year as well. That's the bullish view. This is me making the bullish case for grains as opposed to the bearish video that I did 2 weeks ago. And again, to be clear about my true outlook, not including all of the bullish points or all of the bearish points, of course, some of both, and some views that are in between the extreme ends on certain issues. And so where it all comes together in the form of strategy and recommendations is our work directly with customers, and we invite those conversations, but also within what we're writing in the Comstock report. And we invite you as well to subscribe to the Comstock channel, because this is where you can see our views next time. Thank you.
Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.